In this video, you'll see why banks are being greedy and their actions are not in your interest, literally. In June, the Bank of England increased the base rate to 5%, which hit a 15-year high, but the latest data reveals that banks are not passing on these higher rates to their customers. The UK's financial regulator, the FCA, has received numerous complaints about this, prompting demands for banks to disclose how they determine savings rates. Even the Chancellor expressed concerns about high street lenders taking too long to reflect increased interest rates in savers' returns, especially those with instant access accounts. But what's the issue here? Well, banks generally earn profits by charging customers interest for products like loans, mortgages and overdrafts, and offer incentives to savers through interest on deposited funds. Say for example, you go deposit £1,000 into a bank. In return, the bank pays you the savings rate. The bank keeps some of that money in reserve and lends the rest out in the form of products mentioned above. The thing is, whenever the central bank raises the interest rates, commercial banks are quick to raise their lending rates on mortgages or other products, but they get to choose at their own will how to adjust their own savings rate for customers. As a result, any rise in the central bank rate tends to increase banks' incomes faster than the rate they pay out to depositors. The gap between these two rates has grown. In December 2021, the difference between the average 2-year fixed mortgage rate of 2.83% and the average easy access savings rate of 0.19% was 2.19%. For reference, easy access savings accounts make up 60% of household deposits. Think how much of an impact that has on the whole population. But in July 2023, the gap had widened to 4.03%, with mortgage rates at 6.52% and saving rates at 2.49%, as you can see from this graph from a BBC article. Looking at the commercial interest rates online, I found that it was even lower. So for example, if you decided to put 10k savings in an easy access savings account, you'd get 1.5% with Barclays Everyday Saver, 1.75% with HSBC's Flexible Saver, and 1.4% with NatWest Flexible Saver. Not very appealing, is it? As mentioned previously, this disparity between the base rate and commercial lending rates is beneficial for banks, as an increase in interest rate generally boosts their profits. For instance, Lloyds Banking Group and NatWest reported a 46% and 50% increase in pre-tax profits for the first quarter of the year, respectively. This, understandably, is causing frustration from many groups, including activists, campaigners and MPs. According to The Guardian, Martin Lewis, the money-saving expert founder, said there is a moral case for banks to offer better savings rates to customers after taxpayers bailed out financial institutions after the 2008 financial crisis. Remember that? I wonder who caused this mess. But Martin isn't the only one asking for accountability. Back in May 2023, the House of Commons Treasury Select Committee, that's the watchdog for public finances such as the Treasury, HMRC and the FCA, asked for major banks, namely Nationwide, Santander, TSB and Virgin Money, the following 3 questions. First, how do you determine how increases in the base rate are passed on to your savers? Secondly, why is the interest rate on your Everyday Saver account so much lower than the base rate? And thirdly, how do you communicate with your consumers, in particular those with large balances in their Everyday Saver account, to make them aware of what could be more suitable higher rate savings options available to them? I'm going to focus on the first 2 here because I think this is where the main issue lies. In response to these questions, they said they have to balance the interest of savers against mortgage borrowers who are facing cost of living pressures in a sustainable way. They also pointed out that they have to consider their own operational, funding, capital and liquidity requirements. I've put the link in the description if you want to read the full response. Do these responses sound like weak excuses? The chair of the Treasury Select Committee seems to think so. To be fair, however, some of these banks do have some products which offer higher interest rates, but they are usually capped in limit and are regular savings products. For example, NatWest has a digital regular saver which pays 6% on the first 5k. However, you can only put up to £150 per month. But in my opinion, I think one of the main reasons they are slow to pass on the rate is to increase their profit margins, but not for the reasons you might think. Given the uncertainty around the UK economy, if we were to enter a recession, this might lead to more people defaulting on their loans, which means losses for the banks. So perhaps they are trying to build a buffer to absorb losses if the scenario arises. Just a thought here. But let me know in the comment section, what do you think? Are the banks being greedy or just cautious? Either way, people are losing out from these low savings interest rates, and on the other hand, they are getting crushed by higher mortgage interest rates, which I've explained here. Thank you for watching, and I'll see you next time.